Good afternoon, everybody. Today is Wednesday, July 7th, 2010. This is Brian Shannon from alphatrends.net, and market obviously took off. Yesterday I was saying that it still seemed plausible that maybe we were going to go down and test that 99 level, and perhaps even as far as the 50% retracement of the lows from last March. Obviously the market had other plans here today, and that's why you have to look at this market and say what's most likely and have a backup plan. For me today, the backup plan was to adjust rapidly, and I tweeted early on that the market was kind of stuck at that or testing the 5-day moving average. That was the second day in a row we had seen resistance at the 5-day moving average. It got up to it, and then I had said right here at this point that it looks like the market wants to go higher because it had held that first test of the volume weighted average price for the day and looked like it was starting to break higher. And of course we had very strong readings from the advanced decline line as well. So at the end of the day today we had 2,672 advancing stocks, 427 decliners, and you have to remember we have I think 60 or so inverse funds as well. So that's obviously a very positive broad participation, and all day it was above that rising volume weighted average price. In my midday video to subscribers, I had said that basically we want to give the benefit of the doubt to the buyers today. We had come into the day looking at some bearish setups, including what I thought were possible breakdown candidates was BG. We were looking at shorting that on weakness though, which never occurred. ITW on weakness as well, and Joy Global on weakness, which never occurred either. So we were looking at basically short below yesterday's low. So we adjusted midday, and I had said that we basically wanted to look at Akamai right in here, Ariba right at this point right in there, Cirrus Logic was at 1640, Netflix was 110.50 or so, and then SanDisk, which was the slower one to get going, but I'd mentioned that on Twitter as well. That in fact I'd mentioned the entry on Twitter right here, I believe, and for a day trade, and just got out right there at the close. So hopefully some of you guys participated in that as well. The lesson here is though that you have to be flexible in your opinion. You have to look at the market and say, well, after we've had this horrific decline, and we held within 2 pennies of the 38.2% retracement on that weekly time frame. The exact retracement to the penny was 101.11, and we had seen a low of 101.13. So in the S&P 500, again, I had just seen a question on Twitter there. Can you talk about where was it? Can you try to talk about how to handle the urge to try and pick a bottom here? Thanks. That's from Day Trading Zoo. And Day Trading Zoo, the way I see it is, from a swing trading standpoint, when we're below a declining 5-day moving average, all of your long side trades should be for day trades only. Yesterday was a perfect example of that. When we get back above that 5-day moving average, and that 5-day moving average begins to flatten out, and we're above a daily volume weighted average price, then you want to look at the market as innocent till proven guilty on an intermediate term time frame. That is for swing trades. Of course, you still have to consider the bigger picture though, and as far as picking a bottom that may last, I think it's kind of foolish in here to try to say that this is the bottom and that we may not continue back down towards that 95 level at some point this year. For now, what we have though is we have another situation similar to, and let me just add another 10 days to this SPY. We have a similar situation to what we have right in here, given that last rally. So once we're back above that 5-day moving average, and that 5-day moving average flattens out and begins to rise, then you give the benefit of the doubt to the buyers and you say, where does this market have the potential to go? So those become our price objectives. So for the SPY today, I was pointing out that 105.50 was where R2 was, and that's a potential area where the market would slow down. And we had also mentioned that this 105.70-ish area was a 38.2% retracement of the most recent decline. So which is another potential level of resistance. We've run through that level, and now perhaps we're headed up to a 50% retracement up near about that 107 area. The fact is, the daily time frame is still badly damaged. We've got a declining 10, 20, and 50-day moving average, and right now we're getting a bounce, and the volume's decent. But again, if you were short today, you obviously got hurt badly, just like the longs got hurt badly the last couple weeks, which is, again, why I always look at this market, and I'm amazed that people still try to invest. To me, it just would drive me insane to hold through all this volatility and not try to profit from it. So today was a good day. Yesterday we had kind of that false start that kind of looked like maybe it was going to rally, but this was 2 days in a row where we had basically the same kind of setup. Not so much the same setup, because on Tuesday we had seen the gap higher, of course, but we had seen that little pullback, and then the market got right back above the volume weighted average price. That's where I went and got long yesterday. Now today we had kind of the same thing in here, that I was this is where I had gotten long. The SSO is basically what I had chosen. I didn't hold it till the end of the day, but it was still a good long side trade. And you want to look at it and say, okay, well, I'm taking this trade based on the 1 minute time frame in conjunction with this 10-minute time frame, and the fact that we're holding above this 5-day moving average. You can also look at it and say, well, that's also been kind of this, the 5-day moving average has pretty much defined this downtrend as well, as far as this trend line goes. So I was looking at it as, I'm not trying to pick the bottom necessarily, but I'm trying to pick a point where it makes sense that we might have some continued upside. And if I was wrong, where does my stop go? My stop in there would have been 15, 20 cents away, similar to what I was talking about here late in the day with SNDK, that it looked like it was going to get going. I think it was right around in here. And that my stop was going to go at what did I say? Or that wasn't where it was. It was actually over in here where I tweeted that and said that my stop was going to go at 42.85 actually. So that. So I was looking at it saying, well, here it looks like maybe we're going to develop some momentum, and I'm not trying to pick the low in SanDisk. I did say it was for a day trade only, basically because we're still below that 50-day moving average in this stock, and I figured we were breaking past this resistance. That resistance we had seen later in the day, kind of broken and then act as support. We could see that actually a little bit more clearly on the 5-minute time frame, that resistance had become support. And I was hoping that it would maybe get up to daily R2. It didn't, of course, but as I said, it was a day trade, so I wanted out. So so back to the question is, how do you prevent yourself from trying to pick the bottom? Well, buying weakness is something that never makes sense to me. People will say, the pros buy weakness and they sell strength. To a degree, that's true, but it doesn't mean you buy as the market is caving in and has a clear pattern of lower highs and lower lows, which is what we have had in this market up till basically last Friday. We had this higher low in here, then this higher high, but the 5-day moving average, and that's what I was saying last Friday, was if you learn one thing from me, the direction of the 5-day moving average is where you want to put your intermediate term trades towards. Now, for a much longer term investor, you look at the 40-week or the 200-day moving average and say, what's the direction of that? I'm not an investor, so I don't pay a lot of attention to the 200-day moving average. I'm familiar with where it is and that sort of thing, and I'm familiar with this bearish cross, and we spoke about the bearish cross, or the death cross, last Friday as well, saying that basically there is no statistical edge to getting short on this so-called bearish event. So leave that for the headlines, leave that and spinning tops and dojis and all the other little things that sound cool in technical analysis to people who want to sound cool. Instead, focus on what are the short-term dynamics. Is there there a low risk entry point where I can get in? And if I can get involved and the market tells me basically you are correct in being involved here. And why does the market tell me that? Because I didn't get stopped out. If I got stopped out and it broke down through there, the market would have basically said you're wrong. This emerging uptrend that you think is developing is not occurring, so you've got to move to the sidelines. But if it continues to unfold and shows that pattern of higher highs and higher lows, then you give the benefit of the doubt to the buyers and you look at the direction of the volume weighted average price and say, to me, on a day trading basis, when we're above a rising volume weighted average price, it's foolish to sell it short, regardless of what the daily time frame might say. The daily time frame is still bearish looking, but that's not going to prevent me from participating in a 3% rally today. The S&P, how often do you get 3% rallies? It takes you, I don't know, probably 2 years to earn that if you were to buy a CD, for instance, right? If you talk about, the risk-free rate of return. So the point is, and the long-winded answer to your question is, you have to just have some basic tools. And for me, the direction of the 5-day moving average and where we are in relation to it is what tells me from an intermediate term standpoint whether I should begin to give the benefit of the doubt to the buyers or not. As I said, I came into this day with a bearish bias because I was thinking that there were more stocks looking weak, and the key is flexibility of opinion. And I was saying that it's hard to trust the short side of the market when we have had such a strong sell-off here the last 2 weeks, and therefore you've got to be light on your toes and look for the opportunity. So the market today obviously got a little bit ahead of itself. I think it caught a lot of people off guard by getting back up through that 105 area. 104.50 to 105 had really been the area of prior support in here that kind of became resistance for a short period of time. So here we have this band of prior support which has acted as resistance, and today we blasted right up through that level. And as a result, when you have a lot of people looking at that number saying I'm short as long as we hold below 105, well, it's everyone to the other side of the boat. The fish are biting on the other side of the boat. Drop your lines in over there. The longs are what's hitting right now, not the shorts. And we got, I think you could say that we got a little bit ahead of where this market rationally should have gone, but the market isn't rational because the participants aren't rational. They're motivated by emotion, and the charts allow us to take a look at those emotions as they unfold on the chart. So I would think that what we want to see now, if this rally is going to be able to sustain, is that we want to see that 104.80, 104.60, let's call it, area hold as support. If we were to gap lower down in towards that area, I would be looking for the market to regain its volume weighted average price tomorrow, and then see if we could see something like this unfold, or where let's say this was today's close. Let's say we gap down tomorrow and we continue lower, then we start to go like this. Well, what I would be looking for is here's what the volume weighted average price would be. I would be getting long right in here with a short below the low of the day, thinking that if we're holding support or what should be support near this 104.70, that we begin to see more opportunity to the upside potentially, with now eyes toward the next target, which based on Fibonacci you would say a 50% retracement might bring us up towards that 107 level. And this market, you can look at, you can laugh at Fibonacci, or I don't take it all that seriously, but when you consider how strong these Fibonacci levels have been, if you take a look at the highs from 2007 to the lows of 2009, and we came within just maybe 50 cents of that 61.8% retracement from this move. And then once we had that move and we started to move lower, then you take a look at the Fibonacci in here, and we came within 2 pennies of it. Okay, and then you look at this most recent little Fibonacci that from the lows back in here on May 25th to this high was exactly 50% retracement. So this you know, these numbers, and why do these Fibonacci numbers work? Is it because there's order to the universe, and that's the way that the Parthenon was built, and the flow of sunflower seeds, and the perfect beautiful face has these ratios? I think that's a lot of, I wouldn't say nonsense, because that would be closed-minded, but the fact is the reason it tends to these levels tend to be important in the market is because enough traders say, hey, I'm going to stop buying when it gets to that 50% retracement level. Another group says, hey, I'm going to start selling when it gets to there, and you have more supply and less demand, and then the market, you know, breaks support levels, and then that's when the sellers take control until we see that process over and over again. It's a function of the market searching out the equilibrium, finding that, you know, what's that perceived fair value. And we have new information to go on all the time. We have jobs reports, we have you know, all kinds of you know, news and headlines, and next week it'll be earnings that will be the big motivator. But you know, we have to just look at price action and say, who's in control, the buyers or sellers? The buyers took control of the intermediate term trend today. How long they hold on to that is anyone's guess. We may gap down to 100 tomorrow. That doesn't seem likely to me, but you know, we're in a damaged market here overall. So anyways, that was kind of a long-winded answer to a question, but at the same time, I was saying that, you know, what we want to see now is a pullback, and then maybe we can start to go up towards this gap level and that 50% retracement in the S&P 500. The Nasdaq also had a strong rally up through the important support that it had broken near about 4360-ish, and you know, where would Fibonacci take the Nasdaq? Well, we can look at that and say, from this high to that low, we didn't quite make it to the 38.2% retracement. So that's just one piece of the puzzle. What we want to see right now in the Qs is probably about this level, about 43.20. We want to see that hold as support, and that would be the basis of a higher low, that if the market begins to rally again, we could get long and keep our stops and see what the market rewards us with, or if it tells us we're wrong altogether. The Russell 2000 has been the laggard here recently, although it did have a 3.5% rally today. It's not quite up nearly as high as some of these other markets, and you look at, you know, the prior support acting as, you know, we're still within that area where this prior level is kind of, we're right back up to it. So the relatively, I view the Russell as a little bit weaker, and you know, we'd want to see maybe about $60, and I think even down towards about $60.10 hold as support tomorrow. The semiconductors had a big day, up 4.8%. So the semis, if you look at them as far as, you know, what have we retraced from this recent decline, we're up to the 50% retracement level here. So there's some relative strength in the semiconductors. The financials are, you know, had a real strong percentage move as well, 4.4%, right up to their 50% retracement level. So why couldn't the S&P 500 continue up towards their 50% retracement is the way I look at it, when you have strong financials and you have a strong semiconductor group. But we have to, you know, look at this market now and say, well, do I buy here? To me, it doesn't make sense to be a buyer after this 4.4% move. Instead, what do we want to see? We want to see maybe a pullback down towards 2650 that holds. Even down, I would say, as low as about 2620 would be okay, as long as we can hold above that rising 5-day moving average. But when we have a damaged daily chart like this, you simply cannot be chasing these types of rallies, because you have to figure that a lot of it does have to do with short covering, but at the same time the shorts are on the run, and it's, you know, is it real buying if it's short covering? Well, if it was real selling when they sold, of course it's real, because it still affects the supply demand imbalance, and we can't chase them though, because it, you know, because the daily time frame is, we're looking at that going, wow, this thing's still a big mess up in here, but you know, they make for some great short-term trades, and that's really what you have to look at it as far as you know, a good short-term trade. Let's see. Well, you mentioned the 629 as gap is the next test, and so that was a question from Doward Law. Yeah, and Doward Law, that I mean that gap level from 629 pretty much comes into play near that 50% retracement. I mean, if you wanted to say exactly that gap, up to 107.67, that's fine. Not all gaps get filled. Not all gaps get filled. That is an absolute lie. In the market, it tends to, they do tend to get filled, but not all gaps get filled. That is absolutely not true. In the market overall, that is the broader indices, it does tend to do that, though. Let's see. Chart Diva is saying, for what it's worth, SPY 50 EMA is still above the 200 EMA and leveling out. Same with the NASDAQ. And, it's again, simple versus exponential. And what is the value of a crossover? There is no value in moving average crossovers, in my mind, as far as a trading signal. To me, they represent indecision, that we have these different trends basically intersecting each other. And it says that you have to be looking at the bigger picture and saying, well, okay, we got down, we got this bearish cross after what was that, a 9% sell-off, but we're still looking pretty ugly on the weekly chart. We could get up to even as high as 110 maybe, and we'd be up at that 40-week or 200-day moving average, and then that could be the basis of the next lower high. That right now we're in a pattern of lower highs and lower lows, so we have to see where this market rallies, and basically we're still possibly in for much lower lows at some point this year. I'm not going to guess that game. That's completely irrelevant to what I try to do, which is try to manage risk and make money on I try to make money every day. It doesn't happen, obviously, but that's the goal, is to make money. So can we pretty please have a TA lesson on your nice SN? And Chart Diva really knows how to get her questions answered because she asks them so nicely. Anyways, SNDK, where were we? I think we did talk about that, so hope I answered that. Market Financial saying, head and shoulders with moving averages provide more than indecision, especially given fundamentals in the economy aren't changed. Agreed. It's there's a lot of in Stock Addict saying all boils down to statistics, probabilities, and numbers. To a degree, I would agree with that, Stock Addict, and I'm not trying to be argumentative. To me, it all boils down to price action. Only price pays. So if we're looking at this market and we're saying this is stupid that the market is rallying, this doesn't make any sense, or I'm shorting here because it's R2 or it's up too much, and you're fighting momentum, statistically, maybe 80% of the time that trade works, shorting against R2, but what's today's statistic is what I'm most interested in. And black market got into that SNDK, so that's cool. Glad, because you're getting a little tired of that 48.20 or what was it, 43.20 level. Anyways, thank you, Eric. Upsider, I don't know what I said, but thanks for the shout out there. Let's see, if a pattern or candle pattern succeeds 70% of the time, then it has merit. Can't agree with your generalization. Well, we can agree to disagree then, because 70% of the time it gives you an odds, a reason to look at a trade, just like the Fibonacci gives us a reason to say, okay, we're at this 38.2% retracement level, and historically, such a retracement might be buyable 70% of the time. I don't know those numbers. I'm not a statistical trader, so I think if you can use those statistics and you have to remember, though, what I think is that what is a head and shoulders pattern? There's a lot of people that say no, that's not a head and shoulders pattern, that's a descending triangle, or that's that's an inverted cup and handle, or whatever. So you run into those issues. If you can say 70% of these retracements turn into a buyable event, that's what makes them useful. Now, to a large group of people, and that large group of people start to say, okay, I'm going to stop selling down there. Another group says, I'm going to start buying down there. And also because, as somebody had pointed out to me, I think it was last Friday, that the volume weighted average price since the lows of March 2009 in the SPY, this is the volume weighted average price. We basically hit that. So that becomes an even more important level as far as the psychology of the rally off the March lows. So Stock Addict, I think you can use them both in conjunction and say, okay, here's where we have a percentage advantage. Now, does it make sense to just buy blindly at that retracement? In this case, you can look back and say, yeah, it did make sense. To me, though, it made more sense to be a buyer today when there was momentum, when it was turning away from that level. So I don't think we're really too far off base on that. I think that it makes sense to be aware of what those statistics are, but to use them as part of the analysis, and that's the way it is with anything. That's what people will say. Well, the PE doesn't matter. Other people say, well, the PE does matter. I look for, because there's funds out there that look for a PE of 10, so they spend all day looking at stocks with a PE of 10, and if that motivates them to buy or sell, then it does matter. But to me, it's not a reason to buy or sell. It could be a measurement of value. It's looking back over the last 12 months. But anyways, it's all a mental game and trying to determine what matters now. What's the relationship between gold, oil, and the gold, oil, and the U.S. dollar? Well, sometimes people tell you there's a 90% correlation between those three, inverse correlation. But other times those correlations get completely blown apart, and that, the statistics and that sort of thing, and I don't mean to keep going on and on about this, but that's what blew up long-term capital management, is they were trading that, as they said, what we're trying to do is pick up nickels in front of a bulldozer. Well, and they scooped up a bunch of those nickels, but then the bulldozer eventually got them because there's statistical arbitrage models, and that's what it is, statistical arbitrage, that says this percent and that percent. They decoupled, and when they decouple and you get the 100-year storm, which Hank Paulson said, one of the smartest things I heard Hank Paulson say about a year and a half ago is, we seem to be getting these 100-year storms every 5 or 6 years, and that's what blows apart all these hedge funds that get loaded in the direction of this so-called correlated trade. To me, I kind of get a perverse kick out of it when these correlated trades go uncorrelated, because the market just isn't that simple. There's nothing you can do 70% of the time. 70% of the time gives you an advantage, but without strict money management, 70% is useless, because 30% of the time it's gonna blow you out of the water. So anyway, Stock Addict, didn't mean to go on and on about that, but hopefully I made my point. And anyways, like I said, I don't think we're too far off base there. Anyways, everybody, thanks for tuning in. Looks like that's the end of the questions here. Either that or my Twitter's not refreshing. So with that, I would say have a great rest of the week, and I will talk to you again on Friday afternoon. Thank you.